This presentation looks at the use of monetary policy to control inflation. In particular, it looks at the information which is used by the central bank in an economy to decide when to use monetary policy to control inflation in an economy. The essential point to understand is that whenever we make a policy change, for example, whenever the central bank changes the bank rate, changes the interest rate that it charges to commercial banks, there is what we call a time lag. Time lags are gaps in time, in other words, certain periods of time, between the policy change and its effect on the economy. So any change in policy does not have an effect on the economy immediately. There is always a gap, there is always a time gap or time lag between the policy change and the effect on the economy. Now, when it comes to changing interest rates, this time lag is easy to understand because, obviously, if a firm has taken a loan at an interest rate of 7%, and then interest rates go up, the bank has to give the firm some warning, some period of time, before it raises the interest rate, so that the firm knows that it will soon have to pay a higher level of interest. So this is just one example of a time lag. Banks can't just increase interest rates, usually on loans immediately. They have to at least write a letter to the people who they've lent money to, saying that from such a date in the future, the interest rate will be going up. But this introduces a time lag. Now, in reality, there are many other time lags between an interest rate change and its effect on the economy. And when we ask ourselves how long does it take between a change in the bank rate and a decrease, shall we say, an increase in the bank rate and a decrease in consumption and investment spending, well, statistical analysis of information, of data, has shown that this time lag can be anything between 6 months and 24 months in a typical economy. So depending on the circumstances, there can be a gap of between half a year and 2 years between the central bank changing the bank rate upwards and any change being seen in consumer spending and investment spending as a result of that rise in the bank rate. Now, this is, of course, a very long period of time. 6 months, anything between 6 months and 24 months can be the time lag. So what this shows to us is that timing is very important when we're talking about the proper use of monetary policy. We have to time our interest rate change correctly. And this is one of the hardest tasks faced by any central bank, is the task of timing the policy change accurately. Now, within the central bank, there is a smaller group, very senior group of people who form the Monetary Policy Committee. And this group, consisting of about 15 people, including the governor of the central bank, the boss, is the group whose task is to set the bank rate. Now, they have monthly meetings, and in these meetings, they look at some data from the economy. They look at some information from the economy, such as, for example, the oil price. Oil prices are very important in determining the cost of production. They also look at house prices and how fast they're going up. They look at share prices, and they look at high street spending, among other data. But these 4 pieces of data are particularly important because they tell us something. They are the signs of future inflation in the economy. The emphasis being on the word future, because the central bank is always looking ahead. For example, if the oil price is going up and is predicted to continue going up, this could cause cost push inflation in the future. If share prices and house prices are going up, people will soon start to feel more wealthy, and this can cause them to spend more of their income. So consumer spending could go up because people feel that they own an asset such as a house or some shares, which are becoming more valuable. Lastly, high street spending is of course a measure of how much people are actually spending at the moment, how much shopping they're doing, and therefore this is an indicator of how much demand pull inflation could take off in the near future. So by analyzing this this data, such as oil prices, house prices, share prices, and the amount of consumer spending, the Monetary Policy Committee makes a decision. If the Monetary Policy Committee fears that inflation is about to accelerate in the economy, it will increase the bank rate. Now, the question is how much, but that is well beyond the limit of any course before master's level, really. So, in discussing how much the bank will increase the bank rate, that is a more complicated question. But what we're trying to explain here is that it has to increase the bank rate before inflation starts to accelerate. So it has to do it in advance. So we see that there will be an increase in the bank rate if inflation is feared. And after a certain period of time, this increase in the bank rate will change the behavior of households and firms and cause them to spend less money, to consume less, by borrowing less. And hopefully, if the timing of this policy change is accurate, there will be no increase in the inflation rate. So in this way, the central bank hopes to stave off or ward off increases in the inflation rate of an economy before they happen. So it tries to stop inflation accelerating before it actually happens. So we have seen that the Monetary Policy Committee analyzes information on a monthly basis, information such as the oil price, house prices, share prices, and high street spending. By analyzing this information, the Monetary Policy Committee of the Bank of England forms a forecast or a prediction of what the inflation rate will be in the economy in the future. If it thinks that the inflation rate is going to rise and is going to exceed the target inflation rate, which we know to be 2% plus or minus 1%, if they think that inflation is going to rise and go beyond this upper limit of 3%, it will do something. And what it will do is it will use contractionary monetary policy. It will increase the bank rate. But the crucial thing is this thing of time lags. There will be time lags between a change in the interest rate and the effect that we wished it to have on the economy, which is a decrease in consumer spending and investment spending. And because of this time lag, timing is all important in the efficient use of monetary policy to control inflation.